50 states will see a tax cut with the big, beautiful bill. Now, is this true? Will Americans in actually all 50 states see a tax cut? Well, let's find out. So, what does all 50 states actually mean? Well, no matter where you live, Uncle Sam will now take less. Okay. That's every state, and every state will see an average cut starting in 2026, with the average cut being around $3,700. Now, your cut might be a little bit more, your cut might be a little bit less, but the average should be around $3,700 per taxpayer. So, a tax increase was coming. This law killed it. Let's talk about it. So, the Tax Cuts and Jobs Act cuts were set to expire after 2025. But the One Big Beautiful Bill extended these permanently. So because the hike never arrives, millions save by default. So is that all? No. First of all, we have a bigger standard deduction, right? So a higher standard deduction actually lowers taxable income for almost everyone. So in 2025, right, it's $15,750 now if you're single, and $31,500 if you're filing jointly. And most households actually skip itemizing because the standard deduction saves them more. So because it applies everywhere, this alone actually spreads the tax cut savings to all 50 states, simply based on the higher standard deduction. And by the way, this standard deduction is pretty abnormal because it's actually 2 times the normal inflation bump, right? Some people might say, Graham, we get an inflation bump with the standard deduction every year, but just know that this one was actually 2 times higher than the normal bump. All right, and let's talk about the child tax credit, right? Family slash taxes dollar for dollar with a stronger credit. And now we have an increase in it. So the credit was made permanent and raised, right? Permanent and raised to $2,200 per child. And the refundable portion of that continues. So $1,700 in 2025. And because credits reduce tax liability directly, the benefit is immediate. So how does this play out in real life? Well, let's look at a family profile. We have 2 kids in Ohio. For real families, the math means thousands back. So a middle income couple with 2 kids will get $4,400 off their tax bill. Not off their taxable income, their actual tax bill, right? So that covers maybe 3 months of groceries or wipes out summer daycare, right? But that's a lot of money back in families' pockets. And once again, because the credit is dollar for dollar, relief is felt immediately, at least when tax time come around. But it's not just for families because workers actually benefit as well. So tips and overtime is now untaxed. So for millions of workers, extra pay is now tax free. So no federal tax on tips, right? And it's retroactive to 2025. And overtime is now excluded from federal taxes. This is temporary, but still a big win. So how does this actually feel? Well, whether you're blue collar, white collar, night shift, or double shift, right? Every hour, extra hour now pays in full. That goes a very long way for workers today. So let's look at a worker profile. We have a nurse and a server. So shift work and service jobs finally pay off in full. So nurses on double shifts, well, overtime pay goes straight to her bank account. With the server, every tip now stays with her family. It's not taxed anymore. So for both, that's hundreds more each month they actually get to keep right in their pocket, right? But seniors aren't left out of this. Seniors now have a new $6,000 deduction. So retirees keep $6,000 more before taxes actually bite. So the extra deduction for those 65 plus is through 2028. not yet made permanent, but we have a few years to reap the benefits of this deduction. And that's on top of the standard deduction. So you got the bump in standard, and now seniors get a bump, just an extra $6,000 bump for that deduction. So because many seniors actually live on fixed income, every dollar now stretches further, at least until 2028. So let's look at a senior profile, right? We have a retired couple, right? And a simple deduction protects retirement income. So married couple, 65 plus, now they get a $12,000 extra deduction when combined there. This keeps taxable income low, shields pensions, right? Savings, and that's a full year of medical premiums, right? In math terms that they get to keep in their pocket. But that's not all, right? Because homeowners actually see a higher SALT cap, right? So property taxpayers in high tax states finally get breathing room. So the SALT cap lifted to 40K through 2029. Then it's right back down to 10K if these are not made permanent. There are phase outs above 500K in income, but because many states got squeezed out of this, right, when the SALT cap was at 10K, right, high tax states, property tax states like New Jersey, right, California, for example, used to be capped out, but now they get to make benefit of this. And it at least flattens the field for most of the nation temporarily. So how does this look for a real homeowner? Well, let's look at a New Jersey property owner, right? We know that the higher SALT cap saves big in high tax states. So this New Jersey homeowner pays 40K in property tax, and now that's fully deductible when it used to only be 10K. Huge. So 30K more versus the old 10K cap. And that's worth roughly 1 to 2 months, right? That higher deduction there. It's on average worth 1 to 2 more months of mortgage payments now for a typical New Jersey homeowner, for this example. All right. So for high tax homeowners, this law can be the difference between drowning and breathing, right? Would you take an extra 30K in deductions if you could? I would. But let's look at some caveats and some expirations here. The overtime exclusion we know are temporary. The senior deduction is through 2028. The SALT cap, that increase from 10K to 40K, is through 2029, and then it goes back down to 10K. So because of politics, permanent isn't always actually permanent. We see these phase outs here. But let's look at how savings shift over time for this. So your cut rises, dips, then rises again, okay? So in 2026, the national tax cut across all 50 states will be around $3,700. In 2030, that will drop down to around $2,500, right, as some provisions expire. And in 2035, it's going to go back up to around $3,300 per taxpayer. All right, as inflation grows, some credits and some deductions, like the standard deduction, for example. So, what should you be thinking about moving forward? Well, you want to lock in savings right now while the rules are fresh, right? So, tipped and overtime workers, you want to check payroll plus reporting. Make sure you're getting, um, make sure you're getting that no tax on your tips and your overtime. Make sure that is properly in place right now. All right, families, you want to update your withholdings for the credits. Homeowners, capture that SALT deduction while they last, because once again, IRS guidance actually lags. So you want to get ahead of all of these things here, right, before the IRS guidance even hits. So here's the bottom line. One law delivers cuts across all 50 states. The amounts differ, but the direction, right, tax cuts going up, doesn't differ that much. Families, workers, seniors, homeowners all get to keep more. And the Tax Cuts and Jobs Act extension means bigger deductions, right, credits and exclusions stacked together. Now, because every lever pulls taxes lower, every state saves. And with that, that's exactly how the White House and the Trump administration is claiming that taxpayers in all 50 states will see a tax cut. Now, you let me know in the comments, do you actually believe that you will be part of this group that gets tax cuts? Will you believe that you are part of this group that will not see anything, or you'll just have to wait and see? Let me know in the comments. But as always, my name is Karan, and I'll see you in the next video.